For decades, capital allocation followed a rigid divide. Wealth generation stayed in the stock market, while social good was the domain of philanthropy. These goals functioned in entirely different worlds. That divide is fading. Modern investors expect their portfolios to reflect their personal ethics and social priorities alongside their financial goals. Entering this space means navigating a sea of loosely defined jargon. Terms like ESG, SRI, and impact investing fill marketing brochures, though they are rarely explained precisely. This confusion fuels a specific anxiety. Many investors worry that applying a moral filter to their capital creates a mathematical certainty of lower returns. To make sense of this, we must organize these strategies into a clear, logical progression. We map these approaches onto a spectrum of conscience. It ranges from simple ethical screening on the left to engineering specific real-world solutions on the far right. Identifying where a strategy sits on the spectrum clarifies exactly how a portfolio is managed. The spectrum begins with ethical investing and negative screening. This baseline strategy uses moral principles to filter out SIM stocks, companies involved in alcohol, tobacco, or weapons manufacturing. Basic screening relies heavily on a company's own ethical claims. Without external verification, it is difficult to know if these moral standards are actually being met on the ground. This moves us to the next phase, corporate governance. This is the internal system of rules and duties that dictates how a company is directed and controlled by its board. To verify performance, analysts look to global disclosure frameworks. Standards like the GRI, SASB, and TCFD provide specific metrics that force companies to be transparent about their environmental and social impact. These frameworks provide the verifiable data needed to move beyond corporate promises. They ground the investment process in hard evidence rather than marketing. ESG integration uses this objective data to identify and manage operational risks. It makes the strategy more active by seeking out resilient companies while avoiding sectors with high liabilities. Portfolio tilting provides a clear example. Capital weight drains from heavy carbon-using sectors and moves towards low-carbon industries while keeping the portfolio diversified. Positive screening takes this further by funding best-in-class operators, rewarding companies that lead their sectors in progressive practices. Shareholder engagement offers a more direct path. By holding equity in flawed companies, investors use their voting power to pressure management to adopt sustainable practices from the inside. At this point on the spectrum, the investor acts as a reformer, using their ownership rights to influence corporate behavior directly. The far right of the spectrum focuses on impact and thematic investing. Impact investing deploys capital to fund specific solutions. Success here requires a measurable social or environmental effect, in addition to a financial return. This includes strategies like green finance, which targets renewable energy technology, or blue finance, which focuses on sustainable marine resources. At this endpoint, capital goes beyond simple ethical screening. Investors engineer portfolios to produce specific, tangible outcomes in the real world. We have to address the concern that these restrictions hurt the bottom line. Reducing the number of available stocks can certainly limit performance in the short term, but the long-term data suggests a different result. Companies with high ESG scores are often fundamentally better at mitigating operational risks before they become financial disasters. Strong internal controls and sustainability metrics help these firms avoid regulatory fines, supply chain failures, and reputational damage. This chart shows how the FTSE 4Good and Dow Jones Sustainability Indices track the broader market over time. Because these companies manage risk effectively, their long-term growth often keeps pace with traditional benchmarks. These frameworks give modern investors the tools to prioritize their values while managing their financial future.